I'm in San Antonio for NAREIT's REITwise, our 2019 Law, Accounting, and Finance Conference. Joining me today is Rob Barton, Director of Global Real Estate Accounting Advisory with Chatham Financial. Rob, thanks so much for joining us.
You bet.
Now, let's start by talking about the transition from LIBOR to SOFR. Do you think it's going to be a slow and steady conversion or more of an overnight transition?
It's an interesting question, and it's still, of course, fairly speculative at this point, but there's really two big buckets. I think prospectively, there will be a time when banks just simply don't lend on LIBOR and don't execute swaps on LIBOR, and that piece of it's probably more overnight. It's probably going to be a one-time prospective adoption. Now, on existing loan agreements and existing swaps, it might be a different story. Do you reopen every single loan agreement and renegotiate it, or is there kind of a wholesale change that's made across the board? Yet to be determined, but there could be a piece that's overnight, the prospective piece, and then there could be a piece, the existing piece, that's more of a slow trickle.
And how does the LIBOR-SOFR transition impact the probability assessment required under hedge accounting?
Yeah, so under hedge accounting, it is key to assert probability that whatever you're hedging will exist through the maturity date of the derivative. So if you have a 10-year swap that goes out to 2030 or something like that, how can you assert probability that the LIBOR-based transactions will actually be there post-SOFR conversion? It's a tough assertion to make. The goal of the transition from LIBOR to SOFR is to minimize transfer value. So simply put, the FASB doesn't really see this as an economic change. They don't want to see it that way. At least that's what we're hearing indicatively at this point. So chances are that the FASB will likely issue some type of transition guidance that removes that burden at an otherwise burdensome time. Just mechanically switching to SOFR will be tough enough. So to have to redesignate every trade that's under hedge accounting, that would be quite a burden.
And lastly, picking up on FASB, they currently have hedge accounting on the technical agenda in the initial deliberations phase. What additional changes that are being considered might impact REITs?
The main focus, I think, for the FASB at the time being is ASU 2017-12, the hedge accounting guidance that came out about a year and a half ago. I think they're still focused on technical issues relating to that standard, and how is that conversion going? Has it gone well? Is there anything that they need to tweak? From there, I think probably 18 months into the future, they might start to look at some other areas, namely FX hedging. In certain cases, acquiring a business combination that's foreign denominated, that's going to be tough for hedge accounting. There's a lot of roadblocks there. So maybe opening up some of those doors. That's still fairly speculative at this point, but that is a pain point in some cases for REITs, is to hedge a foreign currency acquisition. That could be interesting, as well as deal contingent type of hedging. So if you've got a potential deal that's going to happen and you want to hedge it, a lot of issues around probability assertions there. It might be worth a second look into that area as well.
Great. Rob, thank you so much for joining us.
You bet.
For more information on this and other REIT news and analysis, be sure to visit NAREIT's website, REIT.com.